This is Module 5. How aggregate demand shocks and aggregate supply shocks create the business cycle. A demand shock is a sudden unexpected event that dramatically increases or decreases demand for a product or service, usually temporarily. A positive demand shock is a sudden increase in demand, while a negative demand shock is a decrease in demand. Either shock will have an effect on the prices of the product or service. A demand shock may be contrasted with a supply shock, which is a sudden change in the supply of a product or service that causes an observable economic effect. 1. A demand shock is a sharp, sudden change in the demand for a product or service. 2. A positive demand shock will cause a shortage and drive the price higher, while a negative shock will lead to oversupply and a lower price. 3. Demand shocks are usually short-lived, but can have longer-term consequences. A demand shock is a large but transitory disruption of the market price for a product or service caused by an unexpected event that changes the perception and demand. An earthquake, a terrorist event, a technological advance, and a government stimulus program can all cause a demand shock. So can a negative review, a product recall, or a surprising news event. When the demand for a good or service rapidly increases, its price typically increases because suppliers cannot cope with the increased demand. In economic terms, this results in a shift in the demand curve to the right. A sudden drop in demand causes the opposite to happen. Other demand shocks can come from the anticipation of a natural disaster or climate event, such as buying up bottled water, backup generators, or electric fans. A positive demand shock can come from fiscal policy, such as an economic stimulus or tax cuts. Negative demand shocks can come from contractionary policy, such as tightening the money supply or decreasing government spending. Whether positive or negative, these may be considered deliberate shocks to the system. How demand pull and cost push forces bring cycles in inflation and output. Cost push inflation, also known as wage push inflation, occurs when overall prices increase, inflation, due to increases in the cost of wages and raw material. Higher costs of production can decrease the aggregate supply, the amount of total production in the economy. 1. Cost push inflation occurs when overall prices increase, inflation, due to increases in the cost of wages and raw materials. 2. Cost push inflation can occur when higher costs of production decrease the aggregate supply, the amount of total production in the economy. Since the demand for goods hasn't changed, the price increases from production are passed on to consumers, creating cost-push inflation. Inflation is a measure of the rate of price increases in an economy for a basket of selected goods and services. Inflation can erode a consumer's purchasing power if wages haven't increased enough or kept up with rising prices. If a company's production costs rise, the company's executive management might try to pass the additional cost on to consumers by raising the prices for their products. If the company doesn't raise prices while production costs increase, the company's profits will decrease. For cost-push inflation to take place, demand for the affected product must remain constant during the time the production cost changes are occurring. To compensate for the increased cost of production, producers raise the price to the consumer to maintain profit levels while keeping pace with expected demand. The main sources of cost-push inflation are increases in money wage rates and the cost of raw materials. Demand pull. Rising prices caused by consumers wanting more goods is called demand pull inflation. Demand pull inflation includes times when an increase in demand is so great that production can't keep up, which typically results in higher prices. In short, cost-push inflation is driven by supply costs, while demand-pull inflation is driven by consumer demand, while both lead to higher prices passed on to consumers. Demand-pull inflation starts with an increase in aggregate demand. The causes and consequences of deflation. Deflation, or negative inflation, happens when prices generally fall in an economy. This can be because the supply of goods is higher than the demand for those goods, but can also have to do with the buying power of money becoming greater. Buying power can grow due to a reduction in the money supply, as well as the decrease in the supply of credit, which has a negative effect on consumer spending. 1. Deflation is the general decline of the price level of goods and services. 2. Deflation is usually associated with a contraction in the supply of money and credit, but prices can also fall due to increased productivity and technological progress. 3. Deflation incentivizes people to hoard cash because they can buy relatively more with $1 in the future than now. This has negative feedback loops that can lead to economic depression. Deflation can be caused by a combination of different factors, including having a shortage of money in circulation, which increases the value of that money, and in turn, reduces prices. Having more goods produced than there is demand for, which means businesses must decrease their prices to get people to buy those goods. Not having enough money in circulation, which causes those with money to hold on to it instead of spending it. And having a decreased demand for goods overall, therefore decreasing spending. The short-run and long-run trade-off between inflation and unemployment. Since both inflation and unemployment are undesirable, the sum of inflation and unemployment has been termed the misery index. Inflation and unemployment are independent in the long run because unemployment is determined by features of the labor market, while inflation is determined by money growth. However, in the short run, inflation and unemployment are related because an increase in aggregate demand temporarily increases inflation and output while it lowers unemployment. The Phillips curve. In 1958, a British economist named A.W. Phillips found a negative relationship between inflation and unemployment. That is, years of high inflation are associated with low unemployment. This negative relationship has been found for other countries and has been termed the Phillips curve. The Phillips curve appears to offer policymakers a menu of inflation and unemployment choices. To have lower unemployment, one need only choose a higher rate of inflation. The model of aggregate supply and aggregate demand can explain the relationship described by the Phillips curve. The Phillips curve shows the combinations of inflation and unemployment that arise in the short run as shifts in the aggregate demand curve move along a short-run aggregate supply curve. For example, an increase in aggregate demand moves the economy along a short-run aggregate supply curve to a higher price level, a higher level of output, and a lower level of unemployment. Since prices in the previous period are now fixed, a higher price level in the current period implies a higher rate of inflation, which is now associated with a lower rate of unemployment. The federal budget process and the recent history of outlays, receipts, deficits, and debt. No single piece of legislation establishes the annual federal budget. Rather, Congress makes spending and tax decisions through a variety of legislative actions in ways that have evolved over more than 2 centuries. The Constitution makes clear that Congress holds the power of the purse, giving it authority to lay and collect taxes, duties, imposts, and excises, and specifying that no money shall be drawn from the Treasury but in consequence of appropriations made by law. In short, federal taxing and spending requires legislation that is enacted into law. The 2 basic categories of federal spending legislation, mandatory and discretionary spending. About 63% of the federal budget is mandatory spending, 30% is discretionary spending, and the rest is interest payments on debt. For discretionary spending, in contrast, the authorizing law that sets up the program, agency, or activity does not itself determine the funding level, which is instead set in annual appropriations legislation. For example, almost all defense spending is handled this way, along with the operating budgets of civilian agencies, medical care for veterans, grant programs such as for education and medical and scientific research, and some low-income assistance programs, such as for housing, that are not set up to necessarily serve everyone who is eligible. The supply side of fiscal policy. The supply side theory, or supply side economics, is a macroeconomics concept that contends that increases in the supply of goods lead to economic growth. Supply side economists argue that the government should increase production through tax cuts and reduced regulation. A fiscal policy, the supply side theory has been applied by several U.S. presidents in attempts to stimulate the economy by targeting factors that increase output and supply more goods and services. 1. Supply-side economics holds that increasing the supply of goods translates to economic growth for a country. 2. In supply-side fiscal policy, tax cuts, lower interest rates, and deregulation help foster increased production. 3. Supply-side fiscal policy was formulated in the 1970s as an alternative to Keynesian demand-side policy. Supply-side economics aims to bolster an economy by implementing policies that will lead to an increased supply of goods and services and subsequent economic growth, such as reducing corporate income tax rates to provide companies with more cash for reinvestment, decreasing capital borrowing rates to incentivize businesses to plan new projects and invest in capital assets such as buildings and manufacturing tools, loosening business or government regulations to eliminate lengthy processing times and unnecessary reporting requirements that often stifle production. Comprehensively, all three variables have been found to provide increased incentives for expansion, higher levels of production, and increased production capacity. In some instances, supply-side economics can be part of a global plan to increase domestic supply and make domestic products more favorable over foreign products. The Laffer curve is the relationship between tax rates and tax revenue. How fiscal policy choices redistribute benefits and costs across generations. Central bank policy has distributional consequences. For instance, by raising interest rates, monetary policy can benefit rich households who earn more on interest-bearing assets, but is usually harmful to poorer households who rely more on labor income and credit. Young and old households systematically differ in asset proportions and labor market participation, making the age dimension crucial for redistributive effects of monetary policy as central bank decisions affect asset prices and labor market developments. Comparing the fiscal imbalance for the current generation versus future generations, it is the case that future generations pay a larger share of the fiscal imbalance. To analyze the distributional effects of monetary policy across generations, we construct a life cycle model with a rich asset structure and new Keynesian characteristics. The model features three types of assets: nominal, real financial assets, as well as housing. The life cycle framework generates a natural environment where agents are heterogeneous with respect to many key economic characteristics, including the level and composition of assets, labor market participation, and the effective planning horizon. As a consequence, households are not only affected by monetary policy via different channels and to a different degree, but also adjust their consumption, housing, and financial savings differently, depending on their age. How fiscal stimulus is used to fight a recession. Fiscal stimulus is an important tool that policymakers can use to reduce the severity of recessions. The federal government provides fiscal stimulus when it increases spending, cuts taxes, or both, to shore up households' and businesses' demand for goods and services during a recession. Strong, well-targeted fiscal stimulus allows people and businesses to keep purchasing goods and services. This bolsters aggregate demand, lessening the recession's depth and length and promoting a stronger recovery. The United States is almost certainly in a recession caused by COVID-19 and the public health measures needed to combat it. A recession is a significant decline in economic activity lasting more than a few months, whose precise start and end dates are determined after the fact by the National Bureau of Economic Research. Recessions can have profound human and economic costs. Prolonged unemployment harms not only workers' jobs prospects and lifetime earnings, but also their families' health and well-being. Long unemployment spells and business failures can also depress the economy's productive capacity far beyond a recession's end. This is why it's important that lawmakers use the policy tools available to them to reduce the severity of recessions. The objectives of U.S. monetary policy and the framework for setting and achieving them. The Fed, as the nation's monetary policy authority, influences the availability and cost of money and credit to promote a healthy economy. Congress has given the Fed two co-equal goals for monetary policy. First, maximum employment, and second, stable prices, meaning low, stable inflation. This dual mandate implies a third, lesser-known goal of moderate long-term interest rates. Fiscal policy involves the use of tax and spending policies by the government. The Fed's interpretations of its maximum employment and stable prices goals have changed over time as the economy has evolved. For example, during the long expansion after the Great Recession of 2007 through 2009, labor market conditions became very strong, and yet did not trigger a significant rise in inflation. Accordingly, the Fed de-emphasized its prior concern about employment possibly exceeding its maximum level, focusing instead on shortfalls of employment below its maximum level. The Federal Reserve monetary policy goals of maximum employment means keeping the unemployment rate close to the natural unemployment rate. The federal funds rate is the interest rate that financial institutions charge each other for loans in the overnight market for reserves. The Federal Reserve Act of 1913 required all depository institutions to set aside a percentage of their deposits as reserves, to be held either as cash on hand or as account balances at a reserve bank. The Act gave the Fed the authority to set that required percentage for all commercial banks, savings and loans, credit unions, and U.S. branches and agencies of foreign banks. The Federal Reserve Board does not participate directly in formulating U.S. fiscal policy. How the Federal Reserve makes its interest rate decision and achieves its interest rate target. The Federal Reserve has several tools that it uses to influence interest rates. As financial and economic changes occur, the Fed has to invent new ways to meet its dual mandate of maximum employment and price stability. One of the most important rates the Fed influences is the federal funds rate, FFR. 1. Federal funds are the reserves kept by banks at one of the 12 regional Federal Reserve banks. The Federal Open Market Committee, FOMC, sets a target for the Fed funds rate year-round. 2. Banks set their own interest rates when borrowing from other banks' reserve funds, but stay within the target Fed funds rate set by the Fed. 3. The Fed heavily influences this rate using interest on reserve balances, IORB, and overnight reverse repurchase agreements, ONRRP. The Fed used to require banks to hold a certain percentage of their deposits in reserves at one of the 12 regional reserve banks each night. If they didn't have enough reserves, they could borrow what they needed. They were also paid interest on these reserves. Interest on reserve balances. The Fed can influence interest rate changes by changing the rate it pays interest on reserve balances. This sets the upper limit for the Fed funds rate because banks won't want to borrow money at a higher rate than the upper limit of the FFR target range. Banks also would not be able to lend for more than this rate because the bank that needs to borrow money would simply go to the Fed's discount window and borrow directly from the Federal Reserve Bank, the transmission channel through which the Federal Reserve influences real GDP, jobs, and inflation. As the Federal Reserve conducts monetary policy, it influences employment and inflation primarily through using its policy tools to influence the availability and cost of credit in the economy. The primary tool the Federal Reserve uses to conduct monetary policy is the federal funds rate, the rate that banks pay for overnight borrowing in the federal funds market. Changes in the federal funds rate influence other interest rates that in turn influence borrowing costs for households and businesses as well as broader financial conditions. During economic downturns, the Fed may lower the federal funds rate to its lower bound near zero. In such times, if additional support is desired, the Fed can use other tools to influence financial conditions in support of its goals. A decrease in the federal funds rate leads to an increase in the quantity of money, a fall in the exchange rate, and an increase in exports. The most direct problem with unemployment is that it results in a loss of human capital. The Fed's extraordinary policy actions. When faced with severe disruptions, the Fed can turn to additional tools to support financial markets and the economy. The recession that followed the 2007 to 2008 financial crisis was so severe that the Fed used open market operations to lower the federal funds rate to near zero. To provide additional support, the Fed also used tools that were not part of the traditional toolkit to lower borrowing costs for consumers and businesses. One of these tools was purchasing a very large amount of assets such as Treasury securities, federal agency debt, and federal agency mortgage-backed securities. These asset purchases put additional downward pressure on longer-term interest rates, including mortgage rates, and helped the economy recover from the deep recession. In addition, the Fed opened a series of special lending facilities to provide much-needed liquidity to the financial system. The Fed also announced policy plans and strategies to the public in the form of forward guidance. All of these efforts were designed to help the economy through a difficult period.